Are you looking to navigate the wild swings of the Bitcoin market but unsure whether to bet on its rise or fall? In today's video, we're diving deep into two powerful ETFs, ProShares Short Bitcoin Strategy ETF, known as BITI, and Valkyrie Bitcoin Strategy ETF, or BTF. Whether you're bullish or bearish on Bitcoin, understanding how these ETFs work could be the key to maximizing your returns. We'll break down how each ETF is designed, the strategies they use, and how they perform in different market conditions. Let's explore which strategy might be your best move in the ever-volatile world of Bitcoin. How does BITI's inverse strategy differ from BTF's standard long Bitcoin strategy? BITI and BTF represent two contrasting approaches to investing in Bitcoin, despite both being exchange-traded funds (ETFs) linked to the cryptocurrency's performance. BITI, or the ProShares Short Bitcoin Strategy ETF, is an inverse ETF. This means its primary goal is to deliver the opposite performance of Bitcoin on a daily basis. Specifically, if the price of Bitcoin declines by a certain percentage, BITI is designed to increase in value by that same percentage, and vice versa. This makes BITI an appealing option for investors who believe the price of Bitcoin will drop and want to profit from that decline. However, because BITI is structured to achieve inverse returns on a daily basis, its performance over longer periods may differ significantly from the inverse of Bitcoin's long-term performance due to the effects of daily compounding. On the other hand, BTF, or the Valkyrie Bitcoin Strategy ETF, follows a more straightforward approach. BTF is a standard long Bitcoin strategy ETF, meaning it is designed to increase in value when the price of Bitcoin rises. This fund typically gains exposure to Bitcoin through futures contracts, which are agreements to buy or sell Bitcoin at a predetermined price at a specific time in the future. BTF aims to provide returns that are closely aligned with the performance of Bitcoin over time. Investors in BTF are generally bullish on Bitcoin, expecting its price to go up, which would increase the value of their investment. In summary, BITI's inverse strategy is geared towards profiting from a decline in Bitcoin's price, making it a tool for bearish investors or those looking to hedge against Bitcoin's potential downturns. In contrast, BTF's standard long strategy is intended to profit from increases in Bitcoin's price, catering to investors who are optimistic about the future of Bitcoin. How closely does BITI track the inverse of Bitcoin's daily performance, compared to BTF's tracking of Bitcoin's positive daily performance? BITI and BTF are designed to track Bitcoin's daily performance, but they do so in fundamentally different ways due to their respective investment strategies. BITI aims to provide the inverse of Bitcoin's daily performance, while BTF seeks to mirror Bitcoin's positive daily performance. However, the accuracy with which each ETF tracks its intended target can differ due to the mechanics of how they operate. BITI, or the ProShares Short Bitcoin Strategy ETF, is an inverse ETF. Its goal is to provide the opposite of Bitcoin's daily return. If Bitcoin's price drops by 1% on a given day, BITI is designed to rise by approximately 1%, and if Bitcoin rises by 1%, BITI should fall by about 1%. BITI accomplishes this by using derivatives such as Bitcoin futures contracts, which allow it to bet against the price of Bitcoin. This daily resetting of the inverse position ensures that BITI closely tracks the inverse of Bitcoin's performance on a day-to-day basis. However, this daily reset can lead to a phenomenon known as compounding error when held over longer periods. Due to the daily compounding of returns, BITI's performance over time might deviate significantly from the expected inverse of Bitcoin's longer-term performance. This means that while BITI might track the inverse of Bitcoin's daily performance closely, its long-term tracking may not be as precise, particularly during periods of high volatility. BTF, or the Valkyrie Bitcoin Strategy ETF, follows a more traditional strategy aimed at tracking Bitcoin's positive performance. It does this primarily through investments in Bitcoin futures contracts, which are agreements to buy or sell Bitcoin at a future date for a specific price. BTF aims to provide returns that are closely aligned with the performance of Bitcoin by gaining exposure to these futures contracts. Because BTF is not subject to the daily reset mechanism that affects inverse ETFs like BITI, it generally tracks Bitcoin's positive daily performance more directly and accurately over time. This makes BTF a straightforward tool for investors who want to gain exposure to Bitcoin's price movements without holding the actual cryptocurrency. While there can still be some tracking error due to factors like the roll cost of futures contracts or the management of fund assets, BTF's performance tends to align more consistently with Bitcoin's overall performance compared to the more complex tracking behavior seen with BITI. In summary, BITI tracks the inverse of Bitcoin's daily performance closely on a day-to-day basis, but its accuracy over longer periods can be affected by compounding effects. BTF, on the other hand, tracks Bitcoin's positive daily performance more directly and consistently over time, making it a more reliable reflection of Bitcoin's overall price movement. What types of Bitcoin futures contracts are held by BITI and BTF, and how do their strategies differ in terms of contract selection and rollover? BITI and BTF both utilize Bitcoin futures contracts to achieve their respective investment objectives, but they differ in the types of contracts they hold, their strategies for contract selection, and how they manage the rollover process. BITI, or the ProShares Short Bitcoin Strategy ETF, holds Bitcoin futures contracts to achieve its goal of providing the inverse of Bitcoin's daily performance. These are typically standard Bitcoin futures contracts traded on the Chicago Mercantile Exchange, CME, which are cash-settled. Cash-settled futures do not require the actual delivery of Bitcoin at expiration, but instead settle in cash based on the price of Bitcoin. BITI's strategy involves taking short positions in these futures contracts. This means that BITI is positioned to profit when the price of Bitcoin declines. The selection of futures contracts for BITI is driven by the need to efficiently track the inverse of Bitcoin's daily performance, which often leads the fund to hold short positions in the nearest to expiration contracts, known as front-month contracts. The rollover process, where the fund closes out its position in the expiring contract and opens a new position in the next month's contract, is a critical part of maintaining this short exposure. Rollover can introduce additional costs and slippage, particularly during periods of high volatility or when there is a significant difference between the prices of expiring contracts and new contracts, known as contango or backwardation. BTF, or the Valkyrie Bitcoin Strategy ETF, also holds Bitcoin futures contracts, but its strategy is fundamentally different because it seeks to provide positive exposure to Bitcoin's price movements. Like BITI, BTF primarily invests in CME-traded Bitcoin futures, focusing on those that are cash-settled. However, BTF's strategy is to hold long positions in these contracts, meaning the fund will profit as the price of Bitcoin increases. BTF generally favors front-month contracts as well, but it may also spread its investments across multiple contract months to manage exposure and reduce the impact of contango. The fund's rollover strategy involves transitioning from the expiring contract to the next contract in line to maintain continuous exposure to Bitcoin's price. This rollover process is essential for BTF to avoid the expiration of its contracts, which could otherwise lead to the settlement of the position and disrupt the fund's tracking of Bitcoin's performance. The effectiveness of BTF's strategy can be influenced by how well it manages these rollovers, especially in terms of minimizing the costs and potential tracking error associated with shifting between contract months. In summary, BITI and BTF both utilize CME-traded Bitcoin futures contracts, but their strategies are opposite in nature. BITI holds short positions to achieve an inverse performance relative to Bitcoin, while BTF holds long positions to capture positive Bitcoin price movements. The contract selection for both typically involves front-month contracts, but their approaches to rollover differ based on their investment objectives. BITI aims to maintain a short exposure, and BTF aims to maintain long exposure, each managing the rollover process to optimize their respective strategies. What are the margin requirements for futures contracts held by BITI and BTF, and how do these requirements affect the ETF's performance? Margin requirements for futures contracts are a crucial factor in how ETFs like BITI and BTF operate and perform. These requirements determine the amount of collateral that must be held to support the positions in futures contracts, and they directly influence the leverage, liquidity management, and overall performance of these ETFs. BITI, or the ProShares Short Bitcoin Strategy ETF, holds short positions in Bitcoin futures contracts. When BITI takes these short positions, it is required to post margin, which acts as a security deposit to ensure it can cover potential losses if the price of Bitcoin rises. The margin requirement for these futures contracts is set by the exchange where the contracts are traded, typically the Chicago Mercantile Exchange, CME. These requirements can vary based on factors such as market volatility and the price of Bitcoin. For short positions, if the price of Bitcoin rises, the value of BITI's short futures contracts will decrease, leading to potential margin calls where the fund must provide additional capital to maintain its positions. This dynamic can impact BITI's performance, especially during periods of high volatility when margin requirements may increase. Higher margin requirements mean that more of the fund's capital is tied up in maintaining its futures positions, which can reduce the fund's flexibility and potentially lead to a higher cost of managing the fund. Additionally, if BITI is forced to liquidate positions to meet margin calls, this could result in further losses and contribute to tracking error, where the ETF's performance diverges from its target of delivering the inverse of Bitcoin's daily performance. BTF, or the Valkyrie Bitcoin Strategy ETF, holds long positions in Bitcoin futures contracts. Like BITI, BTF is subject to margin requirements set by the CME. However, since BTF takes long positions, it profits when the price of Bitcoin rises. The margin requirement for long positions similarly acts as a security deposit to cover potential losses if the price of Bitcoin falls. When Bitcoin's price is stable or rising, BTF may not need to add significantly to its margin accounts. However, in volatile or declining markets, the margin requirements might increase, requiring BTF to allocate more capital to maintain its positions. This could limit the amount of available capital for other investment opportunities within the fund and could also impact the fund's liquidity. If BTF cannot meet margin calls, it might have to liquidate some of its positions, which could lead to realized losses and affect the ETF's performance. The cost of maintaining these margins and the potential need to adjust positions during periods of market stress can also contribute to tracking error, where BTF's performance deviates from its goal of closely following the price of Bitcoin. In summary, the margin requirements for the futures contracts held by BITI and BTF are critical in determining how these ETFs perform. For BITI, the need to post margin for short positions can become more challenging during periods of rising Bitcoin prices or increased volatility, potentially leading to higher costs and tracking error. For BTF, the margin requirements for long positions similarly impact its ability to maintain its positions, especially during market downturns. Both ETFs must manage these margin requirements carefully to avoid forced liquidations and to minimize tracking errors, which can ultimately influence how closely they achieve their respective investment objectives. How does BITI manage the risks associated with shorting Bitcoin futures, compared to BTF's management of long positions? BITI and BTF manage the risks associated with their respective positions in Bitcoin futures, but they face fundamentally different challenges due to the nature of shorting versus holding long positions. BITI, or the ProShares Short Bitcoin Strategy ETF, manages the risks associated with shorting Bitcoin futures, which involves betting against the price of Bitcoin. Shorting is inherently riskier than holding long positions because, theoretically, the price of Bitcoin can rise indefinitely, leading to unlimited potential losses. To manage these risks, BITI employs several strategies. 1. Use of futures contracts. BITI primarily uses Bitcoin futures contracts to achieve its inverse exposure rather than directly shorting Bitcoin. Futures contracts are derivatives that allow BITI to bet on a decline in Bitcoin's price without needing to own or borrow the actual cryptocurrency. This limits BITI's exposure to some of the risks associated with short selling the underlying asset. 2. Daily rebalancing. BITI is designed to provide the inverse of Bitcoin's daily performance, meaning it resets its exposure at the end of each trading day. This daily rebalancing helps to manage risk by limiting the impact of any single day's adverse price movement. If Bitcoin's price rises sharply on one day, BITI adjusts its positions to maintain its target of inverse daily performance, preventing large losses from compounding over multiple days. 3. Margin and collateral management. Shorting futures contracts requires posting margin, which is collateral that covers potential losses. BITI must carefully manage its margin accounts to ensure it meets these requirements, especially during volatile periods when margin requirements can increase. This involves holding sufficient liquid assets that can be quickly accessed to cover margin calls if the price of Bitcoin rises unexpectedly. Failure to manage margin effectively could force BITI to liquidate positions at unfavorable prices, exacerbating losses. 4. Hedging and risk management techniques. BITI may also employ additional hedging strategies, such as holding cash or cash-equivalent instruments, to mitigate risks. These assets provide liquidity to meet margin calls or cover potential losses, reducing the overall risk to the fund. BITI's managers might also use other derivatives or financial instruments to offset risks associated with shorting Bitcoin futures. In contrast, BTF, or the Valkyrie Bitcoin Strategy ETF, manages the risks associated with holding long positions in Bitcoin futures. While long positions do not carry the same risk of unlimited loss as short positions, they are still exposed to significant risks, particularly in a declining market. 1. Exposure to Bitcoin's volatility. BTF's primary risk is the inherent volatility of Bitcoin's price. If the price of Bitcoin falls, the value of BTF's long futures contracts will decline. To manage this risk, BTF diversifies its exposure across multiple futures contracts, with different expiration dates. This strategy helps to reduce the impact of any single contract's performance on the overall fund, spreading risk over time. 2. Margin and liquidity management. Similar to BITI, BTF must manage margin requirements for its long positions in Bitcoin futures. During periods of high volatility or when Bitcoin's price is declining, margin requirements may increase, requiring BTF to allocate more capital to maintain its positions. BTF needs to maintain sufficient liquidity to meet these demands without having to liquidate positions at a loss. Effective liquidity management helps BTF navigate periods of market stress without compromising its investment strategy. 3. Rollover strategy. BTF manages risk through its rollover strategy, which involves selling near-expiration futures contracts and purchasing new ones with later expiration dates. This process, known as rolling the contracts, is crucial for maintaining continuous exposure to Bitcoin's price movements. However, rolling contracts can introduce risks such as contango, where the future price is higher than the spot price, or backwardation, where the future price is lower than the spot price, both of which can affect the fund's returns. BTF's management must carefully time and execute these rollovers to minimize negative impacts on performance. 4. Diversification and cash reserves. BTF may hold a portion of its assets in cash or cash equivalents to manage liquidity and reduce the impact of volatility. These reserves provide a buffer against potential losses and help ensure that BTF can meet margin requirements or take advantage of market opportunities without being forced to sell futures contracts at an inopportune time. In summary, BITI manages the risks associated with shorting Bitcoin futures through daily rebalancing, careful margin management, and the use of hedging strategies to mitigate potential losses from rising Bitcoin prices. BTF, on the other hand, focuses on managing the risks of holding long positions by diversifying its futures exposure, managing margin requirements, executing careful rollovers, and maintaining liquidity to navigate market volatility. Both ETFs employ different but complementary risk management strategies tailored to their respective investment objectives. How do the potential returns of BITI during a Bitcoin bear market compare to the potential returns of BTF during a bull market? BITI and BTF are designed to perform under opposite market conditions, with BITI aiming to profit in a Bitcoin bear market and BTF positioned to benefit during a bull market. The potential returns of each ETF in their respective market conditions differ significantly due to their underlying strategies and the nature of Bitcoin's price movements. BITI, or the ProShares Short Bitcoin Strategy ETF, is an inverse ETF designed to deliver the opposite of Bitcoin's daily performance. In a Bitcoin bear market, where the price of Bitcoin consistently declines, BITI has the potential to generate positive returns. The more Bitcoin's price falls, the higher BITI's returns can be. For example, if Bitcoin were to drop by 5% in a day, BITI is designed to rise by approximately 5% for that day. Over a sustained bear market, with consistent daily declines in Bitcoin's price, BITI could generate substantial returns as long as the daily declines continue. However, the potential returns of BITI are influenced by the daily resetting mechanism. BITI is structured to achieve its inverse returns on a daily basis, meaning it rebalances its positions at the end of each trading day. While this ensures that BITI closely tracks the inverse of Bitcoin's daily performance, it also introduces the possibility of compounding effects. In a prolonged bear market, if Bitcoin experiences significant volatility with both up and down movements, the compounding of daily returns might cause BITI's performance to deviate from the simple inverse of Bitcoin's overall performance over that period. This can both enhance and diminish returns, depending on the specific price trajectory of Bitcoin. BTF, or the Valkyrie Bitcoin Strategy ETF, seeks to provide positive exposure to Bitcoin's price movements, meaning it performs best during a Bitcoin bull market. When Bitcoin's price is rising, BTF's value increases in line with the gains in Bitcoin futures contracts that the fund holds. In a strong bull market, where Bitcoin experiences consistent and substantial price increases, BTF can generate significant returns. For instance, if Bitcoin rises by 10% in a day, BTF would aim to achieve a similar increase in value, assuming it tracks Bitcoin's performance closely through its futures contracts. Unlike BITI, BTF does not have the same daily resetting challenge because it does not need to manage an inverse position. Therefore, BTF's returns in a bull market can more closely align with the cumulative gains in Bitcoin's price over time. However, BTF's returns can still be affected by factors such as the costs associated with rolling futures contracts, especially during periods of contango, where future contracts are more expensive than the current spot price of Bitcoin. These costs can slightly reduce BTF's overall returns compared to a direct investment in Bitcoin. In comparing the potential returns of BITI during a bear market to those of BTF during a bull market, a few key points emerge. 1. Magnitude of returns. In theory, both BITI and BTF have the potential for substantial returns in their respective favorable markets, BITI in a bear market and BTF in a bull market. The magnitude of returns depends on the extent of Bitcoin's price movement. However, Because Bitcoin's price can theoretically rise without limit in a bull market, BTF could potentially achieve very high returns. On the other hand, BITI's potential gains are capped by Bitcoin's floor price, which cannot fall below zero. 2. Compounding effects. BITI's daily resetting mechanism means its long-term returns in a bear market might not perfectly reflect the simple inverse of Bitcoin's price movement over that period, especially in a volatile market. This can lead to either enhanced or diminished returns compared to the expected inverse performance. 3. Risk-return trade-off. BITI's strategy is riskier because short positions can lead to unlimited losses if Bitcoin's price unexpectedly rises. In contrast, BTF's strategy carries the risk of losses only up to the total investment, as Bitcoin's price cannot fall below zero. This risk difference influences the potential returns, as higher risk can lead to higher returns in the case of BITI, but it also means greater potential for loss. In summary, BITI can generate strong returns during a Bitcoin bear market, but these returns are influenced by daily compounding and are inherently riskier due to the potential for large losses if Bitcoin's price unexpectedly rises. BTF, on the other hand, can generate substantial returns during a bull market, with fewer compounding concerns and a more straightforward tracking of Bitcoin's upward price movements. However, BTF's returns may be slightly reduced by the costs associated with managing futures contracts. Both ETFs offer significant potential in their respective market conditions, but the nature of their strategies and the risks involved lead to different patterns and magnitudes of returns.